shared this on social somewhere. I actually didn't do it.
Oh yeah. You make part 2. I'll be.
Yeah. Yes. On social somewhere.
Okay. We are live. Hi everyone. I'm really excited to host Patric Hellermann, General Partner of Fundamental. I highly recommend to check out Patric's YouTube session about disaggregate. It's very insightful. And also I have been looking into blogs on Medium about Fundamental, and they are quite insightful. And so thanks a lot, Patric, for your time for this interview.
Thanks for having me, Myra. I was looking forward to it, and like I told you in the briefing, so first time real time stream, so it's gonna be fun.
I see. So Patric, can you tell us more about Fundamental and like how you joined it? What's your story?
Yeah, sure. I mean, Fundamental is an early stage VC fund that two partners of mine and I co-founded in late 2018. And we invest only in construction technology. So technology that addresses the AEC sector. We love any technology that is as early as, and founders that are as early as, hey, we just had a slide deck, but we're an amazing founder going after a big problem in the market, all the way to later stage, growth stage stuff. So we're very agnostic that way. And finally, we invest globally. So we're actually the only global construction tech funds. About 40% of our capital goes to Asia Pacific, 40% North America and Latin America, and then the remaining 25% roughly Europe and Africa. We want to do a little bit, but we haven't done yet.
Got it. And if I were to ask how Fundamental is different than other VC startups in the space, and what are you especially interested in, what would that be?
Yeah. So that's always a curious question to ask a VC, because all VCs think their brand is so differentiated. So I'm not fully buying that. So I think for us, it really does come down to the focus really on construction tech and AEC, which allows us to have lots of conversations with founders in this space, and only in this space, but also people in our network that serve the space. So really, having seen this market multiple times every day, every week. And then the other thing is the global exposure. So one of the things that our co-investors and our portfolio founders really like is we tend to be in a position where we can tell them a certain playbook or a go-to-market approach from a country that has been successful, and how it might possibly or might not be possibly successful in another country. So this global synergies and learning transfer, that's something that folks typically like about us. And then other than that, I'm not sure how much VCs today can differentiate, but I would say those are two things unique about us.
I see. And your background is also very interesting. And I'm curious, how do you prepare yourself, or how do you spot the trends?
Okay, so you want a short answer or a long philosophical one?
Go for a long one.
Okay, so I think one of the misconceptions that sometimes folks have about VC is that, or actually VCs telling them, is that VC is a trend business, or VC is like these very foresightful people. I don't think that's the case at all. The way to make money in venture capital is typically to be on top of the opportunities and the themes that explode right now. But very rarely do you make a lot of money by betting on trends that would come in 2, 3, or 5 years. That has multiple reasons. The key reason is that you have to make a ton of assumptions that you have to get right in order to be right about a trend in 2, 3, 5 years. And at least we don't think we are able to do that. We're not future scientists or whatever. And so that really is the main reason, which means that for us, when we talk about trends, in your question, or we like to call it more themes, we are typically in the here and now, where we look for inflection, where we look for a company on a continent that really is growing, 5 to 10x in revenue in a year. And then once we have spotted that in a region, we very systematically and methodically look for similar playbooks by similar founders in other countries. So we're very much in the present and not so much kind of hoping or crystal balling the future. And that's something that sometimes people tend to think about VC, but I think that's a misconception. You're very much in the here and now.
Oh, I see. And I'm curious to know, has your investment philosophy evolved over time, or you started with one mindset and it worked out?
That's a great question, Meyer. That's a great question. So the short answer to that is, yeah, it has evolved quite a bit over the last 3 years. Since we did our first fund, we're now in the second fund generation. And I can tell you specifics how it has. And it is still evolving every day. I mean, as an investor, really, you try to be learning as much as you can from the founders. And in one way, for example, how it has evolved is when my two partners, Adam and Shub, and I co-founded Fundamental, all of us came from a relatively traditional VC background, but we had no construction experience. And you know, that was by design. And I would say in many ways, it has worked out well for us. But we came with this very also traditional notion that, hey, software eats up the world, like, you know, market reason, and software as a service is terrific. So the first few investments that we made were actually quite traditional in that sense, that we're looking for software as a service companies in construction tech. The companies in our portfolio, in the first fund, we have about 40 companies in our portfolio, 40. And the companies that grow terrifically well in AEC have been companies that oftentimes are marketplaces. They are very transactional. They are one-stop shops. They are very service rich. They create outcomes. Whereas software, among our very first investments, there has been a lot of software, requires lots of onboarding. It requires lots of training. It requires changing processes, changing behaviors, which in construction, we found out is more difficult than it is in other B2B sectors. So our evolvence here has been that we started to appreciate a lot of founders that build very execution heavy and very service rich businesses. And I would say that is probably the single most, let's say, evolvence over those 3 years.
I see. And from my experience with interviewing budding AEC startups and founders, like one major challenge I foresee in AEC is to find out the right business model and finance because of the type of structure we have and the product. So what is a piece of advice on once we have like a prototype and to test out the feasibility, whether is the market really ready or willing to pay the amount? Like, what's your advice?
Oh gosh, this is so difficult for me, Meyer, because some of the founders that I get to partner with and work with, they know me saying this. So if you watch, sorry for telling you the same thing again. But I like to tell these people, if I was a good operator, I would not be an investor. I would be in the founder shoes. But unfortunately, I'm not a good operator. So the question you're asking me is a question that is easier to or better to pose to an operator than an investor, just because it is so tactical, right? Mm-hmm. Now, what I will say is sometimes the VC investor is in a privileged position to be able to see patterns, like, you know, over 1,000 companies that you see in 6 months, which is roughly about how much we see. What are the patterns that emerge? And so with regard to the, you know, going from prototype to a working business model, I would say one of the patterns is to really try to service your business rather than software your business in the early stages, right? Because if you serve the construction sector or even the AE part of AEC, customers tend to want immediate impact, instant value. That's something that I observe. And so if you service your business rather than software your business in the early days, it might allow you to do transactions faster, gain revenue faster. And the side benefit of transactions and revenue, whatever your business is, I think that's a universal truth. The side effect is that you discover what customers really need and that you can perfect your product. And on top of it, also your model. And I think not all founders are always comfortable with that, to leave selling software aside for a while in the early days, and rather servicing or packaging services around it. And one popular example that I like to use, I guess you were the one viewer we had on our video cast, so thanks for tuning in. But you might have heard me say that For example, if you sell a robot into construction and you're in the early days, you built an awesome prototype, it is working, but maybe not perfect yet. A not so easy way to sell that in the early days is to sell the robot as a license, or to even sell the robot as a hardware. Construction customers want the wall painted, or they want the drywall finished. Mm-hmm. So ultimately, what has worked out for some of the companies in that space is in the early opposite, meaning you give me a contract for finishing or painting 10,000 square feet of your wall. And I just happen to do it with a robot. And so over that, you discover what the customer needs, what the perfect workflow is, what is the way you should model this around, commercially model this around. And you also grow your customer into appreciating the quality of your service. And ultimately, you might actually end up in leasing the robot or selling the hardware where you want it to be. But the journey to go there, I would say oftentimes a service mindset is actually helpful in the early days. Sorry, that was a very verbose answer.
I see, it makes sense. And I'm curious about like the first half of a VC. So you, like from my limited knowledge, you guys also do fundraising first to invest in a startup, like getting, but so like what are
unfortunately, yes.
What are some hustles or challenges as running a VC firm which no one talks about?
I like that. So so fundraising can be challenging for us too, right? And no, it's I think most of the fund managers that are emerging managers and raising a first-time fund, it can take you a long time to actually get someone who believes in you, and that is actually in the journey of a startup that is actually quite comparable. So I think it's a good question. It does become easier once your first fund performs, and then you go after the second fund, you have a track record, and all of a sudden it completely flips. You don't want to raise as much, but people want to give you more and more money, which is what happened for us, for example, in the second fund. We actually had to cap it. And again, that's also resembled in what you want to be in a position as a startup. I think one of the most important learnings, in that is I go with Jerry Jones, owner of the Dallas Cowboys. That is, I would say, essential and not used enough in any fundraising process. If you don't set clear deadlines and you also stick to it, people drag you along forever, because you give free option value to people. The option value is, hey, if you don't cut my process off, I keep on going on, because every day I can keep this dragging, I gain additional information about who else is looking at you, what the dynamic in your round is. And with that information, I can better informed decision, I gain leverage. So the single most important thing to me has been so far, deadlines, get deals done.
Oh, I see. And from your journey, like what are some ideas which you were bullish on, but the market was not ready? Or what were some great ideas, but the execution was not up to your expectation?
Oh, you're setting me up to fail here, Meyer, because whatever I say now, the founders in that particular space of the market will hate me.
Oh my God.
Okay. No, I think, let me, maybe I try to respond first, and you tell me whether that's satisfying in a broader sense, not necessarily construction tech specific. So I think if you zoom out a little bit, right, there have been big buzzwords in the past about, Internet of Things, AI, in almost all sectors. And I'm not sure the hype that has been around at the time has always been satisfied, right? So I think a lot of the stuff that was branded as AI over the past 6-7 years is fantastic data analytics. It comes to the level of AI. Internet of Things, same thing. I mean, while there have been terrific companies been built, I'm not sure everybody got the returns that they wanted, be it founders or investors. And so my take would be, whenever there is a very technologically driven theme, I tend to be I wouldn't say less excited, but I'm not excited because of the technology anymore. What in construction and AEC, what has served us quite well and our portfolio founders is to be excited because of the value, because of the market size, because of lack of competition, tech-enabled competition, not traditional competition, but tech-enabled competition. And then creating a value within that where tech is in the end a tool to deliver a great service. That really is something that we have found to really deliver great value so far. I know I'm not bashing a particular technology here, which maybe you wanted to set me up to, but that's kind of from a mindset perspective what we want to do.
Yeah, that's so insightful. And like being a technologist myself, many times we find, oh, this is cool technology, let me find a use case. So we have like a cool stuff, we are just finding like a right problem or like people to serve. But I totally resonate with your point here. And I would like to go deeper into one cycle. So VC is becoming very dynamic and timelines become shorter and shorter. Can you give us a feeling for how an investment process can go these days?
Yeah, I can. So, I mean, we are seeing, and not just us, right? I mean, all of our peers that we closely work with, I mean, we are seeing rounds sometimes get closed in 24 hours, like the founder comes out and then at the end of the evening, they have the term sheet that they wanted and they close it. That happens especially in very early companies. And I would say that dynamic has amplified over the last year. Another dynamic that we see is pre-revenue companies raising a ton of money. I recently looked at a Latin American firm that raised close to 40 million pre-revenue in the first 4 months of existence. Another one, which also, by the way, is a very Latin American dynamic at this point. And yeah, I mean, great for the founders, especially if you get, as part of that raise, top-tier investors in the round that can also support you over the next raises, which in many times of the examples that I just used is the case. And I think that's great. But what that means also for a specialist VC like us is, not only do you have to actually be very early in building a great relationship with the founders. For us, it's also paramount to actually demonstrate value in a way where people say, hey, I understand you might not have 10 billion under management, which we don't. And there are those that do. But you have something else to bring to the table, which is a global view, which is, you're the largest global investor in contech. That is some signaling effect. Other people, other investors trust us as a company more because you are involved. So that's something that we have found, and that as the market becomes as quick and as dynamic as it does, has become more important for us and also for our portfolio founders. So yeah, it is like you say. I mean, it's wild.
Yeah, and I remember in one of your episodes, when you talked about you have different strategies for developed markets and emerging markets.
Yeah. So that is true. Like I said at the beginning, we have we deploy about 20% Europe, which counts as a mature market. We do Eastern Europe, which is more on the brink there, and then about 30% North America, which also is a mature market, and then the other 50% really stay in the emerging markets, being LATAM, Asia Pacific markets, and Africa. And I would say one of the key differences is that in the mature markets, founders often are confronted with legacy in the construction markets, legacy being legacy relationships. So for example, if you think about a distributor in North America or a distributor in Europe, they have a very strong history of relationships with their clients, and it's not easy to disrupt that at all. Take that same relationship into Asia Pacific or LATAM, and you don't have that because distributors tend to be smaller. They have been around not so long. Logistics has always been an issue over the past decades. So there's a much bigger opportunity in the emerging markets to actually leapfrog those relationships and build a much better experience, which is difficult, more difficult in the mature markets because stuff has been reliable, right? So what that means for us in terms of investment strategy is in the emerging markets, it oftentimes can be quite fruitful to look for one-stop shops, to look for very service-rich marketplaces, to look for those companies that are very execution ops heavy. In the mature markets, you oftentimes need some software-enabled service component to it. So that's one example of how we differentiate that.
I see. And I'm curious to know, is there any hotspot or particular cities or countries where you see more cutting edge prop tech development? Yeah.
Surprisingly not. I would say we came in with that hypothesis into the first fund generation in 2018 that there would be a few hotspots, Singapore, London at the time, also because the countries were driving certain construction adoption pretty much top down. But it's surprisingly global, really. I will say the one country that I have a lot of respect for in terms of construction tech, and it doesn't get enough recognition, is Australia. That's actually a pretty terrific hotspot for contech and great founders that come out of there and then scale very sizable and great companies globally. But besides Australia, there are many hotspots I would say that are pretty cool.
I see. And also, like in states, we are seeing a trend where companies are moving out of Silicon Valley, in Texas, Miami. Like, the pandemic also created a different like shift in those hotspots.
I agree, absolutely. We see the same. That's not construction or AEC specific, but it also affects us, absolutely.
Yeah, and I know like every person has their own recipe on filtering out different startups and noise. So can you share the non-confidential aspect of what are the metrics you use and lessons learned from your experience with working in startups?
So we have made the experience that within construction tech, success can look differently. And applying a too rigid or too templatized framework to what success looks like, you might actually get surprised by certain awesome companies and that you filtered out too early. So we are not we are trying to be more for looking for qualitative factors that substantiate quantitative factors. So let me explain. First, it depends on the stage of the company. So if a company is at a let's say second or third financing round, we do expect to see strong growth in revenue and in adoption. We do look for very strong cohorts. That's the most important factors. But we try to substantiate that with qualitative factors, and that always is team and the references we get on teams. That is a very strong driver of the team. Market size for us is extremely important, and we love businesses that, as I said, service rich and one-stop shop. And then we like it when they really are the first tech-enabled player in their respective market. That's something that we like a lot. So that's, let's say, second, third, or later financing round. For companies that are earlier than that, a lot really is about the team, the market, and being the first mover in that market. A bonus for us that comes from our specific positioning is we love to double, triple, and quadruple down on businesses where we know the playbook from another country. So, for example, when we invested in we were early investors in an Indian company called Inframarket, which now is actually a multiple times unicorn and has been a very successful company for us, and very grateful that we could partner with them. And that allowed us also to scout for very similar businesses in Latin America, for example, which allowed us to invest in another terrific company in Latin, which resembles the Inframarket model in its own interpretation, called Tool, T-U-L. Terrific company. And so whenever we see that, hey, this playbook we recognize from another success story, then we get really excited.
I see. And what gives you the most satisfaction in work?
Probably the founders. It's if you work with great founders and great people, it's you never have the feeling like, oh my God, I have figured it out. You never have, because these founders are always 3 steps ahead of us, because they are in the trenches, right? And they know what to do, they know their markets, etc. And if you're humble about your job, and I like to think we are, you really realize how awesome it is to work with people who can explain what they are doing and what's happening in the world, and what a privilege it is to actually work with these guys. So honestly, I mean, that's the most fun part. And COVID actually, in a way, has allowed us to do more of that, because we have always been globally investing, right? But before COVID, we tried to cover part of it also via traveling and meeting people in person. Everybody has become so comfortable building a relationship also digitally that our investment model has become really easy. And so I get to work with even more smart people. That's pretty cool.
I see. And you also mentioned it briefly, and I hear often that VC look in team and founders, and they prioritize that more sometimes compared to idea. So can you drill down a bit, like what are the characteristics you are looking in a founder or a team?
So I would say these are not fundamental specific things, and many successful VC funds before us have invented these things, and they do work. So when it comes to team, first of all, there needs to be a strong chemistry, because you can only partner on a 7 to 10 year journey if you actually feel like you have a good working relationship. So believe it or not, but in the end, if you don't really get to chemistry and trust with each other, you cannot do it. So that's the first thing it starts with, which is very interpersonal. Then a team needs to have, for us, a strong ability to fundraise. That oftentimes comes with great communication skills, being precise, being tangible, being actionable about what you do, but also at the same time just being empathetic and being a good person to talk to. So communication skills and the ability to narrate an equity story is a skill that we look very strongly for. And then thirdly, execution skills. We do look very much for data points and validation points that a team is able to execute on whatever they crafted. And as part of execution, we look very much for discovery. We like founders who have not necessarily figured everything out. That's very rare. But who can demonstrate a process or a track record for discovering very, very quickly, which in the early days of a company, we have found to be really important. So chemistry, communication skills, execution skills, and as part of that, discovery. That really is where we look for data points and validation. And a lot of that is in the direct interaction. A lot of that is also in reference check.
Got it. And like I have taken few entrepreneurial class, but I don't know this part of the cycle. Like, so from an outsider view, it feels like if I have a startup, I'll be pitching to a VC investor. If you like the idea, you will invest. So one metric is like, how do you evaluate like the value of a company? Second is during the journey, like what I assume is like you have stakeholder meetings, and sometimes you guide the vision of the startup or help them meet like push the boundary or push more customers as a VC. Like how is like that aspect?
Okay. Yeah. Let me try to answer the first part, because I think that's quickly, and then try to pivot to the second one. Yeah. So with regards to valuation in early stage companies, it is more of an art than a science, really. But let me break that down a little bit. So it does actually become quite consistent and methodical for most venture investors as the company has reached a certain revenue scale. In marketplaces or in software companies, there are certain market. So let me give you an example. If you're a market business, often investors would value you after, let's say, you have reached 10 million of annualized gross revenue. So the revenue that goes over your marketplace before you take your margin, somewhere between 2 to 4.5x of an annualized gross revenue. in a software business, I mean, multiples have become really crazy. If you're a software business, on the net revenue, sorry, the annualized net revenue, so the ARR that you make, right now you are seeing multiples between 10x if your company is growing fairly slowly or the margins are not great, all the way up to 100, 120x is something that we are seeing in the market. If you grow exceptionally fast, have very strong margins, and serve a very deep market. So as you can see by that bandwidth, that is quite broad. It does become really more of an art in the very early stages, and oftentimes what let's say you just founded your company, you do your first round. What most investors would revert to is that, hey, let's do it at 25%. Company sells 25% to the investors, and then let's agree on the amount of money that you require. And then the valuation really is oftentimes more of a result than an input.
I see.
Yeah. Sorry, you have to remind me of the second question.
Even I got lost. Like what? Yeah, like I think like over time, like what's your role? Like once you get your funding, then what's your next relationship with them?
So that's probably one of the things that differs the most among venture investors out there, where everybody has their own philosophy. And I think it's very important for founders to figure out what they really want in a partner. For us, we have found a model where we try to engage very strongly in let's say ad hoc relationships where the founder pulls, but not fundamental pushes. So for example, I'm right now looking at my WhatsApp chats here, and I would say just by eyeballing, I probably have like 35 active chats just from today with founders and also co-investors. And that with the founders in those chats, it's always because the founder pushes, because the founder pulls, right? And that very much is part of our philosophy. There are also more formal cycles, for example, board cycles that you try to be active in and try to be helpful. For us, we don't take board seats. We don't do that from a philosophical point of view, because we think most businesses operate well when the operators operate and not the investors operate. But we are happy to get involved in board cycles if the founders and the other co-investors find that we do. So that's something that we do. And as a result, what you can see there is we're not hands-off, but we're hands-off until we are being asked. And then when we're being asked, that's when we get really involved. That's when we try to be extremely helpful. And so far that has worked quite well for us. I
see. And let's say like we have a Shark Tank scenario and all the folks from Fundamental are the investors. What are one or two slides I should keep in my pitch deck that will excite you the most, or what are the metrics I should include first? For sure.
Oh, I've never asked myself that question. Let me spin the question slightly differently, if you allow me, Meyer, because that makes it easier for me to respond. I'm interpreting your question in a way what I think is underappreciated oftentimes in pitch decks. So I think oftentimes the market is not properly appreciated by founders, because whether you serve a 20 billion or 200 billion market, both might sound like big numbers, but in terms of the attractiveness of a business, it makes a huge difference. And then sometimes people think writing 200 billion on a slide, that'll do it. I mean, I'm the first to say most venture investors, we are not smarter than the operators. And I know I am not. But a little bit of our homework we also do. And market size is one of those things. So if you just put 200 billion on there, but you have no way to actually properly substantiate that, not from a, hey, Gartner says, or whatever, McKinsey says, because that I'm not interested in, but more from a methodical point of view, framing that market properly and then coming to a 200. If you don't do that, that is oftentimes not really exciting. So I would say an appreciation for a great market slide is quite high among investors. And then definitely nail your team slide. Like I sometimes get these slides where the team slide is 3 founders, and I get the picture from the beach, I get the picture with the dog, and I get a picture of someone with a chef's hat cooking. Honestly, that's not doing it for me, right? So tell me why you are relevant for this business, and use the space on that slide to do that. It can be logos, it can be references, it can be prior experiences if it's not in the logos, but like that's what you should be telling, and why you have deep insight in this. And also, I think there are sometimes founders wasting a good opportunity.
Oh, that's such a great piece of advice. Like I never thought about the same. And like coming back to your point where when you're investing in a team, you see how closely they are, what's the relationship, and that team slide could give that impression for sure.
Absolutely. Actually, that's if I may, Mayer. So actually, one of the cooler slides that I've had in the last while was actually where the team slide was spent mostly explaining how the founders have worked together for 10 years, what relationships they formed, and what discovery process they have gone through that led to this business. That actually was a slide that I think investors found pretty useful.
I see. And I have numerous times where I have seen articles where some AI startups in construction mention it's a $1.5 trillion industry in US. There is huge room for productivity. And yeah, like, but there's also the industry, like from from my experience, like the data sharing, there is some messiness in the whole cycle. Like it's not that easy problem there. Oh, this people are not doing this, let's tackle this. Like, and many times these are people from outside AEC industry, so their assumption or their experience before entering the industry and after dealing with the industry is totally different.
Yeah. I have the same observation, Meyer. And in fact, someone from a large construction company told me the other day, and I'm just quoting them, so this is not, I can't claim copyright on this. They said, you know, Patrick, we get founder calls every week. I'm paraphrasing a little bit, it was in a different language, but I'm getting founder calls every week, and et cetera, et cetera. And all of them have the same commonality. They have spent 3 months in our industry, and yet they have here the bullishness to tell me what I've been doing wrong for 30 years. And that really is not particularly credible. And you have to say, you know, that sums it up. I think what the most successful founders in AEC might have in common is a certain humility with which to approach the sector, that not everything that has been going on was crap. I actually want to give you an interesting example, Meyer, that now comes to mind that someone else explained to me, which is from, I have to set the context, so from aggregates hauling. So for those of the viewers that don't know what aggregates hauling is, so when, for example, you build a building, you need concrete. In the concrete, you have rocks and stones that get bound together by cement and water. And so these aggregates and stones are called these rocks and stones are called aggregates. Okay. So aggregates get hauled, get mined in a quarry, and then they get hauled by a truck to a construction site, for example, or to a ready-mix plant. Okay, so there have been quite a few companies that try to digitize a lot of this process in North America, for example. So what this guy tells me the other day, who has been operating quarries for 30 years, and who is now in like an executive VP position with one of the companies that serve this, is, so Patrick, not everything that looks old-fashioned actually needs to be digitized. And I said, huh? I mean, explain. And he used the aggregates business as an example. He said, the truck driver drives into our quarry, and at the entrance of the quarry, we have a door. And so with the door, the truck driver, because he serves like 10 quarries, under his windshield has 10 RFID cards or 10 of these like parking cards. And when he comes to our quarry, he puts it in front of the door opens, he drives his truck there, he tells the guy, please load me up 20 tons of this one, here's a paper ticket, sign, etc. So now he leaves again, he drives to the construction site, he gives the paper ticket there, can you please sign, etc. And so he said, a lot of the companies that try to digitize this process start with thinking, how can I open the door digitally? Or how can, and he said, the only valuable thing that you can digitize here is help me get rid of the ticket and speed up the invoicing. But everything else to maybe whatever, monitor the truck or to speed up the door opening doesn't make sense, because it works fine the way it is, even if it looks old-fashioned and legacy. And I think that for me was a pretty insightful moment to think about construction tech in a way where you don't need to digitize everything just because people think it looks old-fashioned. Yeah. And I think that's pretty cool.
Oh, like that's quite interesting and insightful example. And like one of the thing AEC is known for to be last in terms of technology adoption. It's very resistive, and construction is I guess like it's more resistance in like adoption of new. So, and there are young people who think we can change the whole way through tech, and there are old people who know, okay, there are like some nuances, not like there are not that easy, there are complex parameters and things involved. So I'm curious to know your thoughts, like, do you see a tipping point of like technological adoption, or how can we bridge this technological divide among young and old? And I'm sorry, I'm generalizing old people. It should not be the way, but like it's generally what conversations I hear about. Yeah.
Oh gosh. Okay. I'm starting to realize I might appear old to people. Okay, but so maybe two reflections on that, just as a gut reaction. So the first one is, I think in general, I subscribe to the theory that we are much earlier in the digitization process of all industries out there, not just construction, like all of them. We are really in a first cycle of digitization, and a lot of the businesses that will get built over the next, let's say, 15 to 20 years across all industries, we have no idea how big they're going to become. I mean, we discussed 1.2 trillion market cap for Amazon. Honestly, I think that will be the norm for many of the companies that get built in the next cycle of digitalization. And that's a little bit like what the human brain for all of us does. We tend to overestimate how quickly you can generate results in the short term, and we tend to underestimate how big things can become in the long term. And I think that's generally the cycle that we're in, and that also applies to construction tech. So I think right now we're in a wave where a lot of the groundwork of digitalization in construction tech is being built, and on top of that, we will then see a new wave of founders build even bigger businesses. I can't tell you the time frame. It might be 15, 20 years, it might be longer, it might be shorter. I have no crystal ball, I don't know that. But generally I subscribe to that theory. So that's my first conviction with regard to that. The second one is, I think in construction, a lot of businesses that we have supported and or seen over the last few years, we have always come from a let's serve a construction company, or let's serve a distributor, or let's serve a engineering firm kind of mindset. And I think that's the right thing to do. We like service businesses. But I wonder whether in the next few years, we might actually see more businesses that actually do what a construction company does, or what a distributor does, or what a engineering firm does, but in a tech-enabled way. So instead of selling it to train someone else, you just insource whatever that company does, you do it yourself, and you just happen to do it digitally enabled. Going back to the robotics business that I used earlier, that is such an example. We have portfolio companies, 011H, Juno, that are very full stack companies building multifamily homes based off of timber, which is an example of what I'm just saying. Is they do construction, right? They just happen to do it more tech enabled than let's say the average peer that they serve. And I wonder whether that is a general trend that we will see. It could also happen, for example, through a lot of M&A, through a lot of roll-ups, where a lot of the big companies that get built in AEC over the next few years might actually insource some of these legacy activities, and they just happen then to do it tech-enabled.
I see. And I'm just want to touch one point and know your thoughts. So we see like the failure of Katera and Weaver. And do you think the next disruptive company in AEC would be vertical, or what are your thoughts in general?
Great question. So I would say generally I like businesses that can do a lot of value creep. So or I would also say market expansion, addressable market expansion, as in you start with a very strong value proposition in a sufficiently large market, and you master that perfectly. But in doing that, you build so valuable relationships that you actually spot all these adjacent opportunities and you build it around. In a way, Inframarket in Asia for us has been doing just that. They only served initially 3 product categories, and now I believe they serve more than 50 product categories. And they have also built more and more businesses around their core value proposition. So generally, I like businesses that have that level of value creep. But I acknowledge that there are also businesses that just become really valuable in staying in a core proposition. And I wonder whether, for example, especially firms addressing the architecture and engineering community, the design community, especially around 3D, for me is a very, very big and explosive topic, where you just do one thing really well. One thing that gets tossed around a lot is Figma for 3D. I mean, I have yet to see an awesome Figma for 3D, and I think it gets overused a little bit. But in principle, I subscribe to that if you actually can fix something for that very explosive 3D community, you might just do one thing really well, not verticalize yourself, and still become a very sizable and society relevant company. So I guess both manifestations could happen.
I see. And when you mentioned about Figma for 3D, I was just thinking there was a time where VCs were interested in companies like what is Uber for X, what is Amazon for Y, and what is, let's say, Figma for Z. Like, can you give some examples in AEC space which successfully adopted like or translated those models from other industries?
Yeah. So let's maybe stay briefly with the 3D example that I just gave. So I generally like an open source project out there called Speckle, and I think in a way I think of them like GitLab for 3D. So if you look for an analogy, that would be one that I would be using. I'm also currently quite in love with a company out of France, very early, called Rayon, which could get described as like a Figma for 2D space design, which is very counterintuitive because most 3D people would say, hey, 3D is the world. Yes, but for some people, you actually need a 2D interface to do floor plans, etc. And I think Rayon, in a way, has a nice interpretation for that. So if you force me for analogies in like the architecture and 3D space, those would be 2 that come to mind. I also like HyperParse, by the way. I'm not sure the guys would use this analogy, but in my mind, there's an opportunity for algorithms almost for the AE space. This is me saying it, and maybe they would describe it differently. Within, let's say, more of downstream part of AEC, I mean, Inframarket in a way is an Amazon for construction materials, really. It's very much a one-stop shop and full service experience. So I would say that has been there as well. But maybe to round this question off, we have also seen that construction has been minting first-time playbooks quite nicely. So the idea to actually use a lot of the analogical thinking and apply it into construction, it has a lot of charm because it de-risks founders and investors, but I'm not sure that that works always in construction. Whereas some successful companies that we have seen, like Tool in Latin America, they have been writing their own playbook, and actually they are the first of its kind in any vertical. And that's pretty cool about construction too.
It's interesting. And for students or young professionals who just graduated and they are very interested in entrepreneurship, like, what do you think are some underserved areas or areas which has high potential of improvement that they should be considering to develop?
So I would say in the downstream business, there are very good unexplored opportunities around labor as one angle, which is ethical cross-border labor sourcing and helping people cross borders to find work in a very ethical and compliant way. Also qualification of labor. We are running into lots of labor shortages in the mature markets, but also qualification of labor in the emerging markets where you actually help people upskill, maximize their earnings potential in a very ambitious and aspirational way within the emerging markets. So I think generally labor, with the examples I was just giving, is a very interesting opportunity for the next few years. Then fintech and construction tech, for sure. I'm not sure I would always subscribe to the theory that, hey, I can plug into construction volume and I can facilitate all payments around construction. I mean, those theories have been around for a while. I'm not sure it's that easy to approach it from that big angle at first. But for example, buy now, pay later solutions, or solutions that actually can help dynamically optimize payment terms between a distributor and the SMB contractor, for example. I think on that side, there are quite a few opportunities. And then if you go more into the 3D space, you know, anything that we just discussed, like GitLab for 3D and generally collaboration, and helping designers and architects and their clients interface better, I think that's also still a pretty wide space.
I see. And what is some market or area which is saturated?
So we have been seeing a lot in equipment rentals and equipment sharing and equipment secondary purchases. So I think that's something where I would be doing a lot of diligence before I found something. That's probably one area. Quite a bit about logistics in the mature markets, which, if you do something, I would look for something to do around warehousing in the mature markets as well as the emerging markets, but not necessarily around the trucking side. I think that has been explored reasonably well the last few years. And then when it comes to project planning software, etc., I would want a very good reason to found something in that space.
Got it. And if you have unlimited time and resources, what would Patric do?
Specifically to my job, you mean?
I'm leaving it open-ended.
Probably retire.
Oh.
So one of the, I mean, if you're asking me about like a hobby project or like a, you know, what would I do if I had this unlimited time? So one of the things that I'm really passionate about, basically, making sure that animal rights are being protected and animals actually get elevated in their rights to human rights. That for me is a very passionate thing. So, you know, if you want to do something there, hit me up.
I see. Cool. My last section of the interview is rapid fire, and you'll have a very short time to think about a question and make the answers brief. So my first question is there any book which made a big impact in your life?
Not really. I'm more of an article reader than a book reader.
The follow-up would be, what is that article?
So I read recently a great article about Tiger Global and their new investment strategy. That was really insightful.
Got it. Which city is in your travel bucket list?
Auckland, New Zealand.
Oh, you're very right on point. What is one thing in construction tech I gotta make it very tricky. Like I was about to say you deeply care about, but then like you have a whole spectrum to cover. But so I'll take back that question. But I wanted to know, like, is there anything you wish you would have done differently in your career?
I would, if I could go back, I would study engineering. I studied business. That would be the one thing I would like to change.
I see. And how does a day in your life look like?
Getting up fairly early at around 5:30, doing lots of emails, trying to do sport, not always succeeding. Then, doing emails up until about 9:30, having breakfast with my wife, and then full day calls.
I see. And how do you make your calls more productive?
I tend to shorten my calls. I mean, I do have some calls where I insist on 15-minute meetings, and usually it's to the benefit of both sides. That's not for every call, but generally just being shorter about calls and then forcing people on both sides to be really succinct.
I see. And what are some common mistakes or potential mistakes generally a startup makes, which you advise we should avoid?
I can probably speak better about, let's say, mistakes in fundraising than about operational mistakes. I would say in fundraising, you don't put deadlines enough, or you try to create FOMO too much. Investors talk with everyone. And so for you to believe we don't talk with each other, that's a big mistake.
I think. Your favorite movie?
Ooh, I'm not sure I have one specific one.
All right, you can answer a couple. Like I just.
Okay, so I'm really bad at these memory things. I mean, one that I've recently been impressed with, maybe to come more from a recency here, was for sure Dune. I really much found that quite epic. Story a bit shallow, but quite epic.
Got it. What are your thoughts on blockchain and metaverse opportunities for AEC?
Okay, back to the technological topics. My initial reaction is newfangled doohickey, but also mootshot could potentially really be world-changing. I see it less as a metaverse topic like Zuckerberg would. I see it more as in plugging into 3D. I think this world runs on 3D. Our entire world runs on 3D. Manufacturing does, gaming does, everything. And so when it comes to creating curated experiences that can be used in or reused in 3D environments, I'm pretty excited about it, but not because someone calls it metaverse.
I see. And what are your hobbies?
Mostly dog and family, really. I mean, you might see the little one here. So yeah, that's and I love American football. Sorry, I should say football, but for Europeans, I have to say American football.
That's a cute photo. And lastly, is there anything you'd like to share which we didn't cover in this interview?
I think if you're thinking about founding right now, there has rarely been a better timing to found a company in AEC. We've seen cross the 11 billion accumulated VC funding in AEC in 2021, and oftentimes sectors have shown that there's a general pattern. Have shown that it takes you about only 2-3 years to go from 10 billion to 50 billion, 50. So the time is really great to found an AEC company if you're currently on the fence.
Nice. And like I'm part of Architecture DAO, and we are like supporting cutting edge projects in blockchain AEC related work. And someday I'd like to know your thoughts on like project building and like metaverse fundraising and support.
Yeah. Let's do a follow-up. I'm currently actually looking into a few of those projects, so I'd love to do a follow-up on that.
Yeah, definitely. And Yeah, because we haven't like we have seen some DAOs doing decentralized VC approach, but I haven't seen in AEC specific way. Like it's community fundraising, and there's a lot of interesting opportunities. I just wanted to throw it out there, but yeah.
No, I like it. I thought the most fun project recently was the one that where the guys bought this single Wu-Tang Clan album from Pleaser DAO. Looking forward to seeing something similar in the build world.
Yeah, actually, I was in New York, and that Rare Pizza DAO, I was in one of their parties. It's a great.
Really?
Yeah. It was fun.
Okay. You have to tell me who else was there, because it's kind of they make a bit of a secret around some of those members.
Yeah, actually, it's they have an interesting story, and in NYC NFT conference, there were a lot of amazing projects I discovered in this space. Yeah.
Nice. Yeah, I'd love to do a follow-up, Mario.
Yeah. Thanks a lot, Patrick. I had a great time interviewing you, and it was quite insightful. Like I look forward to the portfolio of Fundamental and your journey. Yeah.
Thank you very much for having me. That was fun.
Yeah. Have a nice rest of your day. Bye.